Buffett does not usually exaggerate, but this time he used a word that almost never appears in his speeches: fear. And this raises a serious question. Fear of what exactly? It is not fear of inflation or a possible recession. It is something bigger, worse, and deeper. In this video, you will understand exactly why this warning is so serious, considering what it could trigger in the global economy. And most importantly, what you can do to protect your money before this silent threat becomes real. Just before we begin, remember to like the video and subscribe to the channel to help me improve the videos on the channel. But what really caught attention, and may surprise you, was the focus of the warning. Instead of citing cliches, Buffett pointed out a risk that few are observing with attention: fiscal irresponsibility. For him, the greatest danger today does not lie in short-term fluctuations, but in the trajectory that seems to ignore basic limits of sustainability. By the way he expressed it, he is not suggesting a sudden crisis. He is describing an inevitable rupture should the current pace continue. The logic is simple. The United States is spending far more than it collects, and the entire world trusts that this debt will be settled in the future. But what happens when that trust is questioned? It is precisely for this reason that Buffett mentioned the risk to the currency, because the crisis manifests itself first through inflation, the loss of real value of assets, and global instability. And if this begins to happen, it does not only affect the American investor, it also impacts those who rely on predictability to protect their wealth here in Europe. After all, if the dollar begins to weaken, what will the real impact be on European economies and their investments? Before discussing how this affects you, let us first examine the current situation in the United States. The fiscal situation of the United States is, today, one of the most sensitive points in the global economy and one of the least discussed. The current deficit is around 7% of the GDP. This means, in practice, that for every $100 that the country collects, it spends 107. The difference, of course, is covered by more debt, and this debt has already surpassed $34 trillion. Now stop and consider, if you had a personal debt of trillions, and it grew by more than 1 trillion each year, just in interest, how would that end? The immediate consequence of this imbalance is a dangerous triad. First, the possibility of tax increases, something that always creates tension in the markets. Second, the need to issue more currency, which puts pressure on inflation. And third, the most worrying, the reduction of confidence in American Treasury bonds. And why does this matter so much? Because these bonds are the foundation of pension funds, central banks, and the architecture of the international financial system itself. In 2023, this risk began to become visible. The Fitch agency downgraded the credit rating of the United States, and this was a signal that few noticed. But it could be the spark for something much larger than a simple market correction. And the most curious thing? Despite the high demand for treasuries, the cost of financing is rising. This indicates that the market is demanding a higher premium to take on this risk. Think of a company that has been spending more than it earns for 20 years. It sustains this cycle by taking new loans. To what extent can this logic be sustained? When this cycle breaks, it will not be an isolated problem of the United States. You can be sure that you will feel the impact, even here in Europe. For the European investor, the fiscal imbalances of the United States may seem like a distant problem. However, observing the role that the dollar plays in the global financial system reveals how dangerous this perception can be. Approximately 60% of all foreign exchange reserves held by central banks worldwide, and more than 80% of international trade transactions are conducted in dollars. This currency acts as the anchor of the global economy. Now imagine what happens to others when this anchor begins to lose stability. And here is what almost no one talks about. A crisis in the dollar can destabilize your bank, your pension fund, and your wallet. If treasuries lose value, those reserves deteriorate. And this is already happening. Furthermore, an unstable dollar directly impacts the cost of imports for European countries, exerting pressure on internal prices and reducing the margins of exporting companies. When interest rates in the United States rise, a portion of global capital migrates there. In practice, this translates to decreased access to credit, less productive investment, and more pressure on local assets. There are precedents for this. In 2011, when the credit rating of the United States was downgraded for the first time, stock markets around the world recorded significant declines. Now that the scenario is clear, we arrive at the part that separates the protected from the unprepared. How to turn all this into a practical strategy. For this, I will now present 3 pillars: how to protect your assets, opportunities that will arise, and mistakes to avoid. In the last 2 years, central banks have been forced to maintain interest rates at elevated levels. Contrary to what many expected, this reality is not going to change anytime soon. With inflation still resilient, monetary authorities need to maintain the tightening, which strongly pressures fragile companies. The result? What analysts call zombie corporations, companies that are operational but are already financially dead. The number of such companies is exploding. In the United States, it is estimated that 1 in every 5 publicly listed companies does not generate enough cash to even pay the interest on its own debt. In Europe, this number is lower but continues to grow, and any shock in the markets could accelerate this collapse. In light of this scenario, protection begins with a focus on assets that generate real cash flow. Solid companies that pay regular and increasing dividends. Next comes currency diversification. In addition to euro, assets denominated in at least 2 other currencies. Finally, there is strategic liquidity, having a portion in cash ready to be used during correction periods. Interest-bearing accounts and short-term ETFs offer this flexibility with low risk. And here is a decisive principle. The best defense is to be a receiver of interest, not a borrower. When the moment tightens, you want to be on the side, receiving returns, not the side that depends on credit to survive. However, protecting your capital is only half of the game. The other half? Seizing the opportunities that arise when everyone is fearful. Because while there are increasing risks, there are also hidden opportunities. And that is exactly what we will explore next. Why, in the face of so many systemic risks, is there a temptation to retreat? It is precisely during moments of uncertainty that the most asymmetric opportunities arise. The difference between those who protect themselves and those who prosper lies in the ability to see where real growth still exists. And surprisingly, this growth is not coming from traditional centers. India and Southeast Asia have been expanding their GDPs at rates exceeding 6% per year consistently. With increasing political stability and a rapidly forming middle class, local consumption becomes more predictable. As a result, regional and multinational companies with a presence in these areas gain ground, offering European investors indirect access to rapidly ascending markets. At the same time, defensive sectors continue to deliver value even in challenging environments. Companies in healthcare, public utilities, and essential consumption have stable demand, predictable margins, and historical resilience. This is precisely the type of foundation that reduces volatility in a long-term portfolio. Those who believe that Europe has no more opportunities are ignoring objective data. For major names on our stock exchange are also good assets. One just needs to wait to buy them during moments of great panic when they may be up to 50% cheaper. Remember, the next 5, 10, or 20 years will be shaped by the decisions you make now. It is not about predicting the market, it is about being well positioned. And for this strategy to be complete, one essential element is missing: knowing what to avoid. For just one mistake can compromise decades of building. The greatest risk is committing errors that seem harmless at first, but become lethal when the scenario changes. The first of these is leverage. With interest rates persistently high, the cost of money is increased. Operating with debt multiplies the risk of collapse. A swift correction in the market can destroy all your assets. Another common mistake is excessive concentration. Even assets considered safe can suffer significant declines when confidence is shaken. Diversification is not synonymous with complexity. It is synonymous with prudence. And prudence is now a competitive advantage. It is also necessary to avoid businesses that do not generate cash, especially when the system that underpins these assets is changing. From monetary policy to fiscal regimes, it is in transition. Ignoring this is like driving in fog with the headlights off. The fatal mistake today is not being cautious. It is believing that the world will fix itself, only to realize it will not when it is too late. Does this seem exaggerated? It might be, but what if it is not? What would be the cost of having done nothing? That is where the anti-fragile plan comes in. If Buffett's warning materializes, The most extreme scenario involves a sequence of interconnected shocks. A fiscal crisis in the United States could lead to the loss of the dollar's status as the world's primary reserve currency. In parallel, interest rates would surge, putting pressure on companies that rely on cheap credit to continue operating. The so-called zombie corporations would be the first to fall. In this environment, inflation would not only be local but structural and global. And when this happens, savings in fiat currencies begin to lose real value, eroding years of effort in just a few months. Does that seem exaggerated? But what if it is not? To withstand such a scenario, a practical approach is to use the barbell strategy. Keep 80% of the portfolio in safe and predictable assets, such as solid dividend-paying companies, physical gold, or liquidity-protected funds. The remaining 20% can be allocated to assets with greater appreciation potential, such as well-selected emerging markets, small-cap stocks, or crypto assets. The most important thing is to have an anti-fragile mindset, being willing to adjust positions as the context changes, because volatility is not an enemy, it is the price paid for preserving wealth in uncertain times. Buffett did not make a prediction. He pointed out a diagnosis. Now you not only understand what is at stake, like this video, if it helped you see this scenario. And comment, how are you protecting your assets? Share below and help others protect themselves as well. Clear and strategic information is not a luxury. It is the difference between stability and silent ruin. And now you are already one step ahead. See you in the next video.